they ranked 5th overall. Giovanni would like to be a bond manager. Joseph would like to be an investment banker. Wenzel would like to be a strategic management consultant. And Zuhair aspires to be a property investor. And then the testing in terms of the book or movie they'd like to take on holiday. So Giovanni, The Road to Serfdom. Joseph, Gladiator. Wenzel, this is interesting, Investing in the Australian Share Market by Roger Kingsky. Wenzel, I've got in brackets, this has been prepared for me. Wenzel's last name is Kingsky. So it might be his dad or granddad. Yes? No. Whatever. Yes. And Zuhair, his book of choice would be The Intelligent Investor. So, over to you, and we're now about to start again in terms of the case study. So we're back to Amit and Amy, and we're looking at investment through buy-to-let, and I nearly walked away with that again. Good luck, gentlemen.
Good afternoon, Amber and Amy, and thank you for coming to ZKWKGC Financial Advising. We understand you're looking to buy a property for the buy-to-let market whilst maintaining your current lifestyle and sticking to your ethical principles. In this presentation, we'll show you 3 different options. The first option is to buy the £320,000 house you like and make money through long-term appreciation of the property. The second option is to look beyond London and make money through high rental yields. The third option is to wait 10 years before buying so that you're in a financially stronger position to make this investment. We'll show you the benefits of each of these options and our advice on it.
The first option would be to buy a £320,000 house in London now. Here's why you might do that. The likelihood of capital appreciation in the long term is high in London, so buying earlier could be better. This would help make up for the monthly losses caused by an unbalanced monthly budget, as mortgage and loan repayments will be higher than rental income, according to our estimates. This option would also allow for leverage, using mostly borrowed money, to make a profit through future appreciation. In addition, interest rates have been trending down over the last few years in the UK, according to Statista, making it a good opportunity to get a mortgage.
Here's a breakdown of costs and cash of this purchase. The house price, stamp duty, legal and agent fees is just over £340,000. Cash after this purchase is £50,000. It includes Amy's inheritance and home equity loan of £15,000. This alone can get against the value of your home which you outright possess. In other words, the current valuation minus the mortgage you own it. You need this loan in order to have enough for a deposit. Therefore, the mortgage you need is just over £290,000. As a percentage of the house price, this is 91%, which means you need a loan to value that amount, which come with high interest rates of 5 to 6%.
Although you've seen houses like in London, I've considered buying a house outside London. You can find houses in the range of £120,000, and this will be more suitable as the only cash you have is £35,000. Since the house will be cheap, there will be a small mortgage and so a small monthly mortgage payments. There are also higher rental returns relative to house value, in other words, higher rental yields, especially in university towns that range up to 8%, triple those in London. The combination of good rental returns and small mortgage payment makes this option lucrative in the short term. As an example, here's a £110,000 house outside of London. Total cost will be £116,000. The only cash will be Amy's inheritance, leaving a mortgage around £81,000, which is 73% loan to value, which will come with an interest rate of 3%.
The final option is to wait up to 10 years before buying in London, so you are financially stronger. Hopefully you will have both seen real wage growth in that time, so you'll be able to put down more money for the deposit. This will lower the risk of the investment. You will also be better prepared to deal with the extra costs, such as refurbishment or any issues brought about by troublesome tenants. You may also want to consider that stamp duty is currently at a high and comes with an extra 3% for second-time buyers. You may choose to bet on that being lowered in the near future, as the UK has witnessed a more stagnant property market recently.
An important upside of not buying now is that you won't get bogged down in debt. This will allow you to invest into more things that could be of more value to you now, such as holidays, maybe even to New York. At the same time, you should build up your investment portfolio, not only to buy a house, but to prepare for a family, if that's what you're planning.
This will involve investing in ESG exchange traded fund, which is both compatible with ethical values and become more profitable recently. Only a few years ago it was considered niche and something for true in the corner, but now it's become more mainstream, providing good returns, with 73% ESGs being non-issue equivalents according to a Morningstar study.
Now we'll compare the options and give a recommendation. These are the two options for buying now. The loan-to-value mortgage is smaller for the property outside of London, which means lower mortgage interest rates. The rental income is higher in London. However, due to the high mortgage interest rates, and the need for a equity loan, it results in a shortfall of £700 a month, whereas outside of London, the net balance is positive. Judging by historical trends, appreciation is much more likely in London than outside. So, if you're keen on entering the buy-to-let market as soon as possible, recommend you buy outside London, for its immediate profitability, and because of the many risks that come with buying in London now, such as losing your home if you can't pay back a loan.
Now that we've established that buying in London now is a bad option, we can compare buying outside now with buying in London in the future. If you wait 10 years, you'll be in a financially stronger position, which will lower the risk. Also, by waiting to buy the property, it'll be easier to maintain your current ethical lifestyle, as you will have more money on hand than if you were to take on the debt now. Finally, we'll also have the advantage of waiting out the current political uncertainty that has come with Brexit, which may have negative impacts on the property market in the next few years.
Having taken all the advantages and disadvantages into account, we recommend you withhold buying property now and instead buy a house to let in London in 10 years. Seeing as you are both young, we think a long-term investment is best for you. There is a high chance of property appreciation in London, so you should aim to buy there for good returns in the long term. However, it is too risky to make that purchase now, and in 10 years, you'll be able to buy a house of similar value to one you really like without the need of a home equity loan. In the meantime, let's improve and manage your finances to facilitate your future purchase.
Since you won't be spending your savings in the meantime, you will place them into an ISA account. The maximum amount you can put into an ISA account is £20,000, and any interest or capital gains won't be taxed. The cash ISA is where we'll put most of your savings for safe returns. The stocks and shares ISA would involve us putting some of your savings into an ESG index. In terms of ethical investment, the best option in our opinion is the FTSE for Good index, which is beating the FTSE 100 on a 3-year moving average. We expect this to continue performing well as investors transition to becoming more environmentally conscious like yourselves.
Furthermore, you could cut back on spending by making subtle changes. Cut back on water and electricity consumption for financial and ethical reasons. You can also cut back on holiday prices without compromising their quality. Book them for Christmas because that's when prices start to rise, as also begin booking. Travel off peak in June and September, and search for holiday packages to find better deals. In order to improve your credit rating and save money, refrain from borrowing cash to avoid the high APR, pay off all credit card debt quickly at the end of the month. With regards to student loans, you should continue to pay the minimum, so it'll be gone in 30 years, even if you don't pay them all back. You don't want to end up overpaying.
So that's it for our advice. We're glad to continue to assist you with whatever decision you make. Thank you for coming to ZKWKGC Financial Advisors.
Well done, gentlemen. Annabelle, I remembered earlier when you spotted the price of the house that we're seeing. Yeah, £320,000 in London.
Yeah, we know where that is.
Yeah, we all want to know where it is. Yes. Have we got any questions from the panel to get us started?
Have you considered what might happen to property prices in London over the next 10 years? If your advice is to wait 10 years?
Well, we're thinking that they could possibly lower with Brexit, but if they don't, the money that we make through them, through their investments that they give us, should be more than enough to make up for any increases in property prices that we've seen historically.
James, any questions?
Yeah, I was just wondering, so the housing market, you say it's stagnating a minute. Would you not say maybe invest in something that they can have access to in 3 or 4 years' time, and then invest if they think that the housing market is going to fall and then hopefully recover? Did you look at anything like that?
Well, that's why we mentioned that the option is to wait up to 10 years. So they give us the money and we will manage it for them, and depending on how long they wait, it changes the amount of capital available they have to put forward for the loan. So it's really a variable option, and they can decide when they want to jump into the market. So that's why they should probably,
Are I've got a question. So when we talk about Brexit and the impact on house prices, don't you think that that's already happened? And wouldn't it be a good time to buy now after obviously a number of years of uncertainty? Did you look at the property
we
market?
saw that in London, for example, if it was buy now, as we showed, there's 9% off 91% loan to value, which we view as quite risky, since they have an income of 6,000 combined. So we didn't want them to take on any debt, and this would harm their lifestyle, which they've clearly said they want to keep and maintain and got good reviews. So we can calculate and saw that potentially have an impact on that.
Okay, thanks.
Sorry if I could add. The terms of the deal haven't exactly been established, and I think when people see what Brexit actually means, the market will decide whether the property market will fare well or worse.
Sort yourself out there, Thank you so much, gentlemen. Well done.